My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour, Geoff Garbacz has got some phenomenal research and has a really interesting way of framing things. So, Geoff, first time that you and I talk here. For those who aren't familiar with your background, talk about who you are, how'd you get involved in markets, so what do you do now?
Yeah. So when I got out of college a long time ago, I had a choice of going to work for the Bank of Maryland or for a brokerage firm that basically peddled independent research and got money managers to pay for soft dollars. So I did that for 5 years, lived in Dallas and New York, covered accounts in New York at a really young age, covering Morgan Stanley Asset Management at 23 years old, which is kind of a pretty cool thing and pretty uncommon in the late 80s. And then from there, I went to Robinson Humphrey because they wanted to build an area doing soft dollar electronic trading and working with research guys as well. Did that for another 5 years and then said, hey, I can do this on my own, and started a company with one other guy, and then another guy joined us, and we've been doing it ever since. So that's kind of a little bit of how I got into it. I definitely gravitated to the research side and research vendors that were quantitative in nature. So that's kind of how I got into this mix. And then, so that was in 96, we started this up. And then in the early 2000s, I ran across an individual who did stuff on the retail side, and we branched into doing a retail newsletter. It was very successful from kind of the get-go. Our first 18 picks in 2002 were winners, so that kind of made it easy. And so I think I'm unique in that I play in both the pure institutional buy side, hedge funds, money managers, mutual funds, and then kind of more to the retail effort within the market, retail newsletters, et cetera. And then the last couple of years, we've been focused moving into the financial advisor market as well. So kind of three different niches, three different ways that those people want to be covered, have product generated to them, et cetera. But it's been pretty fun to do. So probably have a different background than most people who are in these spaces.
So let's talk about being quantitative for a moment, because there are all kinds of complexities that one can put out there in terms of quantitative research. I wouldn't quite consider myself a full quant like what you would normally see at a hedge fund with PhDs and crazy regressions. I'm quant-ish in the sense that I'm rules-based. But talk about some of the variables that you look at from a quant perspective. And when you're in an environment like this year where things seemingly aren't behaving according to history, does that make you rethink some of the variables that you look at?
Yeah, I think that those are really good questions. First of all, I would probably consider myself more a quant along the lines that you are. The various research groups that I've worked with over time have developed models, and we've done unique things with those models. And I kind of like to start with the idea quantitatively. There's three levels I think about this stuff. There's a great book I read years ago. It's called Data Smog. I don't know if have you read that book?
No, I've come across it, but I haven't read it.
Okay. So the premise of the book is there's three levels. There's data. So let's just take in Erlanger's world as an example. Data would be short interest data that gets released every 2 weeks. We get a number, and then out of it, you can create information. So information in our world would be, hey, what's the short ratio for that? So we look at short ratios a little differently than other people. Our short ratio is share short divided by average volume over the last 12 months. The exchange and Bloomberg it was exchange originally that just did this, and Bloomberg hopped on it. Well, they use average volume over the last 20 trading days, which tends to be more volatile. So we build our own short ratio, which is information. And then the knowledge piece of it is what we call short intensity. How high would the short ratio be historically over the last 5 years? And there's a weighting process to that. So a good example of a stock we'll talk about today will be Visa now has a short ratio of 3.78, our short ratio. And then the short intensity is 88%. For a long time, that's all we used. And then to your point, I think someone with a quantitative background is someone who always looks at the data and says, hey, how else can I improve upon the process? So what we did about 5 years ago is we went back historically and said, hey, what happens every time when the short ratio either gets above 3 and we have a short intensity level above 50% or above 80%? And when it's above 50, we call that short selling moderate. And when it's above that at 80, we call it heavy. So Interestingly enough now, in the case of Visa, it's back to heavy short selling. It's got an 88% short intensity level, as I explained. And we then said, oh, let's look at all the times it's happened. It's happened 5 times historically. And in those 5 occasions, guess what? The shorts got it wrong every time. They lost on average 26%. They've never made money so far. And now they're back for the 6th time in a row. So with the stock down a bunch, seems like the odds are probably pretty good that there could be another squeeze coming. And what's so interesting within that, so this is all focusing obviously on the knowledge side of stuff. Historically, the shorts have stayed about 228 days on average. So they've been very recalcitrant short sellers, refusing to give up until the pain is almost too much. And that, I think, is a great way when you're in this type of period. You look at data and try to figure things out. Another thing, Phil Erlanger, who I work with, he has a great point, which I think a lot of people don't take advantage of as much. Sometimes when an indicator doesn't work, it's almost telling you as much. Hey, this is really screwed up right now. What's going on? Because in theory, this should be working, and it isn't working right now. Does that make sense?
You're preaching to the choir. It more than makes sense because, and I've been very public in talking about this. So, I've skin in the game. I'm an entrepreneur. You would think that in this environment, which some would classify as quote unquote risk off, that these signals, these quant-based metrics that I use to determine where to rotate would quote unquote work. But the complication there is that it's not about the signal, it's more about the opportunity set, because treasuries, as now has been well documented, have wildly correlated to equity to mitigate drawdowns in equities. Well, that's true, but not to mitigate drawdowns in treasuries, which tend to benefit from equity drawdowns historically, and that hasn't really panned out this year, right?
Correct.
So I think that's a very strong point. Now, that lends itself to another question, which is when you're in these inevitable periods, because there will always be periods where whatever indicator, whatever opportunity set you're tracking just are not working for a moment in time. You talk about optimizing a process. Is there something that makes you rethink the underlying premise of whatever indicators you're looking at? Maybe something's different about the intensity around shorting this time than before. I can make an argument that when they removed the uptick rule, that maybe was a structural change to the way shorting took place. But talk through that sort of reassessment process for a bit.
Yeah, and this year is a good example of that. And it kind of goes back to the core of our work. Our work is really based on 3 things. The first thing is, hey, what's the bias? Do I want to be long or short? And we'll talk about that right now as it relates to what you're saying about equities and bonds. But we also look at setups, i.e., hey, short interest. Is there a short squeeze going on? Options as well. Is there a put squeeze or call squeeze? And we'll talk about that also. And then third is seasonality. Hey, what's the seasonal trend? And then the last thing is on the timing side, we call them triggers. We have, I think, some pretty good price-driven triggers, like that would equate to like DeMark as an example. Everyone kind of knows who Tom DeMark is, and he has these various signals that he uses, which are all price-driven. So we've got a couple of those as well that are kind of useful. But coming back to what you're talking about, I think the bias is really the most important variable. If there's only one thing I could do, I would want to know what the bias was. And I want to know it in different time periods. To me, that's a really useful thing to understand. So what's the bias looking at on a daily basis? What's the bias on a weekly basis? What's the bias on a monthly basis? So we use a kind of unique thing. It's called the displaced moving average. So it's basically 2 moving averages that are displaced. And the idea is pretty simple. Whatever time period we're looking at, it's a 6-period moving average. So let's just use the example of a daily right now, because I'll give a couple examples of some interesting stuff going on right now. So it's a 6-day moving average displaced from the high of those 6 days and the low into the future by 4 days. And so you're either trading below it, in it, or above it. And what's interesting right now is we put a lot of this technical stuff into what we call quote sheets. And if I look at it right now, it's pretty much red across the board. Although it's really interesting when I look at major equity ETFs, so Diamond Spies, I use OENQ as opposed to the Qs because that gives me the whole NASDAQ composite. It's a really great ETF to kind of follow for just seeing what's going on with the NASDAQ composite. Midcap and MDY and IWM. So right now, the only one of those that's in its channel on a daily basis has moved into it from below is ONEQ. And the Qs have done the same thing, by the way. But still, nothing is positive on a weekly or a monthly basis. So is that something of interest, yeah, it's the first sign there's potentially something going on. And interesting, treasuries, I track TLT, LQD, and HYG, and those are now, TLT is above its daily channel on a daily basis, so 6 days, so a little over a week. LQD is above it, and HYG has just moved into it from below. First time in, I think, almost all year that has been the case, except for maybe a little bit of the March positive move that we had from the 14th to the 29th on stocks, and also the kind of end of May period where we had like a 1 week rally, and that was it. So to me, that's a really important thing. And as we look across the board, it's almost there's nothing working on the DMA channels, especially on the longer term, which is monthly. If we look across all asset classes, dollar is above its monthly DMA channel. Oil and natural gas are above it. Gold recently moved inside from above it. And that's it. There's a pretty cool ETF out there. I mean, Michael, you probably know this one. Do you know AOR?
Yes. Yep.
Yeah, I like that because it's doing what I just did, which is to kind of look at all major asset classes and say, hey, what's going on with them? And it's negative too. So it's basically saying there really isn't a great investable place right now.
Right. And risk, as we know, has been going through that too, right? And the whole appeal of risk parity is that it's actually based on very sound research that you have these multiple asset classes, you weight them appropriately based on volatility, and that way, no matter what environment you're in, you end up being okay. One of those things that you're allocated to is likely to work. The problem is to risk weight something properly in a risk parity product, you've got to overweight and sometimes leverage treasuries.
Yep.
And so if you look at a lot of these risk parity funds, to your point, that nothing's worked out. But let's talk about bias and intensity here for a moment. So I was just talking with a friend of mine who's an advisor, and he literally was telling me, listen, I'm having a moment here. I'm not quite sure what to do. I'm nervous. I've got a lot of cash. It's very possible that things, the bottom falls out. But yes, there is a scenario where you could see this kind of melt up situation that seemingly comes out of nowhere. It just hasn't happened yet. And even today, as we're speaking, markets rallied hard, then came back in, and suddenly all the defensive sectors are massively green and treasuries are green, which looks more risk off. So talk about where we are here in terms of that intensity, because when you say the word intensity, that makes me put my contrarian antennas up.
Yeah. So let's talk a little bit about the setups, and probably the best setup we have right now on the long side is our sector Erlanger options rank. So let's talk about what we do there. What we do is we look over the last 10 trading days on every stock that has options, and we look at open interest, premiums, money flow, total number of contracts to trade, and volume. And within that, it's not a pure average. We look over the last 10 trading days. It's done on a median basis. So we will throw out like an outlier if something just sticks out like a sore thumb over the last 10 trading days. But what's interesting, typically as stocks go lower, our Erlanger option rank, the number of sectors with a rank above 70 begin to climb. So what's interesting is a week ago, the close of the 10th, we only had 2 sectors out of 24 sectors that we track that had excess put activity. And then a week later, last Friday, all of a sudden we had 23 of our 24 sectors with extreme put activity. And it's killed it. It's done a great job of historically capturing bottoms. So that's something that's going on, right now within the work that's indicative of we're up decently this week, almost in stealth. I was looking earlier in the day when we were a little higher, but the S&P was up 3.16% for the week. It's been an okay week so far.
But it doesn't feel like
I know,
right?
It doesn't feel like it at all.
Because you haven't really had, this has been, let's talk about, everything I do is around sequence of returns, right? It's not about the endpoints, but the dance in between the endpoints. And the issue this year is that you've had this really unusual streakiness on the downside. Usually you don't see streaks on the downside. You big down, then kind of meander, then big down, then meander. So there's been this unrelenting decline. Then you've had interruptions of 1 or 2 big weeks and then back down again. So there's this kind of hesitation. Even though it's been a decent week so far, people don't feel it. They don't.
No one trusts it. No one trusts it, which is really interesting. So this idea right now is that we have excess put activity. We can also get the reverse. A stock runs way too far to the upside in the call activity. Like probably the best stock I've ever seen on that indicator within our work is Apple. I mean, it's flawless. Apple sells off, the puts get high. Apple goes to an extreme, the calls get too high. Boom, it comes down. It works really well in terms of how that plays out. So That's like the first thing that's interesting about right now. And to your point, the S&P through last week had been down 10 of the last 11 weeks since sometime in April. I mean, it's incredible how much that it's just like it's down. And to your point, one thing we track is short interest as well. And I'll give a little bit of this and then come back to it a little more in depth. We have a thing called a type 4, which is a stock that's weak technically and no one is short. So those end up being really great short ideas in a bear market or in a corrective period for a sector, because people go to sell, especially like a widely held name, and there's no one short. So it just drips every day. It just goes lower and lower and can't get its act together. We had a couple of weeks ago, like in our portfolio, Range Resources, a good example, was an energy name that just had no one short. Conoco, which we had in our model short portfolio, we just took it out today. I looked at it, I was like, wow, like it had gone down 19% since the 1st of June. And I'm like, okay, that's enough, because energy does have a lot of excess put activity and it could get a bit of a reversal. So one thing I came across in doing some like analysis of the work started back in 2009 and brought it forward, which was when we get multiple weeks in a row of the type 4s losing money, there tends to be a rebound. And like you can make some really good money when those rebounds occur. And typically they fall after, I begin to track it after 3 weeks, 4 weeks, 5 weeks, or 6 weeks. Well, guess what happened this time? We got to week 6 and we went beyond it. We went one more week. Went 7 weeks. And it's funny. We've now had 2 periods where we got to 6 weeks. And the very first time that happened was back in 2019 in August, when Trump came out and said something negative on the Chinese. And that Friday we sold off 2.5%, and it would have ended otherwise. But I'm like, hey, new range. It could go to 6 weeks. And it's happened one other time since then. And then boom, we hit 7 weeks. And I got a lot of grief from people. People are like, oh, all you're doing is data mining. And I'm like, not really, because all I'm doing is looking at live data going all the way back to 2009, which has encompassed, the end of the 07-09 period. It encompassed 2011, 2015, 2018, the pandemic, and now this time. So, a lot of periods where the market kind of struggled. And sure enough, as I got grief on it, I'm like, it'll happen. It's going to happen. And it was a week later before it occurred. So,
well, and by the way, that point real quick on grief is an interesting one, because whenever you get people sending you messages which are borderline insulting or outright insults based on a thesis, you're probably right, or you're probably close to some kind of inflection point. I can tell you unequivocally, I started getting a barrage last week, and I had a whole bunch of people tweeting saying, you're insane, this thing's going so much lower. And I've seen this before, where the sentiment is so one-sided, where people go out of their way to basically attack your opinion. Because let's face it, when you talk about the future, it's always an opinion.
Yep.
Right? Because nobody knows what tomorrow brings, right? But the people are inherently attacking your opinion, that it makes you start to realize that, the payout is probably higher betting against the crowd at this moment in time. I'll give you a quick anecdote. Another friend of mine sent me a message saying that he did very well. He was shorting quite a bit this year, but he's thinking about maybe changing that bias, positioning-wise. And he said that apparently, and I don't know if this is true or not, but a lot of these 2X and 3X long ETFs are now in the hard to borrow camp, which means a lot of people have been shorting the levered longs instead of going necessarily to the inverse long ones, right? There's better compounding aspects to shorting a long than going inverse, with daily reset. So when I hear things like that, again, it goes back to my contrarian antennas go up, that everyone is so one-sided, and everyone could still be right, but not necessarily right tomorrow. They could be right by the end of the year that things go lower.
Yeah, I want to be in the neighborhood. I'm not going to be able to identify the particular house on the particular corner. But, we finally got the bounce, and it was a good bounce. What's interesting is I hated the bounce, because the week of the 23rd through 27th in a Memorial Day weekend, the entire move was basically Wednesday, Thursday, and then half of it came on that Friday, and the S&P was up 6.84% in 3 days. And the one thing about the idea of this model is that the week after that streak ends is when you get the good move. And then 2 weeks later, we track it, and we track it out a month. And the percentages for the week after are 100%. They still are. But the 2 week percentage is like, that's 85%. And now the 4 week is about 83%. I think that's the number. So I kind of know what those numbers are. And I just felt like oh, this time isn't going to work out really well. And that's exactly what happened. Now, where we are, so we just hit 3 weeks last week. So this is 50% of the times the rally started after 3 weeks. And I feel a lot better about this one because I've got the excess put activity, right? I've got a bunch of our indicators, like Phil loves to create indicators. Stick the guy in a cave and throw him meat and he'll just go create indicators for you. But one of our oversold indicators is kind of there, which is a nice thing. The ENS overbought oversold indicator got to an extreme. And the one thing we haven't talked about yet is short interest. So short interest began to climb last February, so February of 2021. And we're now up like...
Which was that, and by the way, that was the peak, right? That was when small caps started petering out, emerging markets peaked, ARK peaked, right?
Yeah, correct. One thing that I'll kind of along with that to validate what you just said, because I've got the report right here. I love to track like statistically how high we are for, a certain period of time. And yeah, it was that period. Last year, 82.24% of stocks were up year to date. And that was the peak, 212 of 21. When we got that short interest data, it peaked. And then the lowest it's been is actually January of this year. We got down to 19.76%. And we finished the year at 55%. So we went from 82% of stocks up for the year down to 55% of stocks up for the year, which validates exactly what you were saying as relates to that.
Yeah, and I've been making that case that really we entered a bear market, I would argue, February of 2021, because that's when breadth started aggressively weakening. And if you go with that as a starting point, which is debatable, I understand that, but if we go with that argument, I always make it a point that every storm is a function of not just intensity, but duration. So you've had now over a year of this horrible internal dynamic environment of the market. Now, yes, It can go a lot lower. Nobody's debating that you can't go lower, but again, I go back to the sequence of returns. It seems very possible that the market does what it does, which is that it screws the most amount of people who think they know what tomorrow brings.
Yeah,
which kind of goes back to the melt up these.
Yeah. So on the short interest, it's been climbing, right? It's been climbing, and Nasdaq it looks like Mount Everest now. I mean, it's an extreme high. Whereas New York Stock Exchange looks more like the Rockies on a multi-year base. It's there, but it's not a crazy number. And what's interesting is one of my friends who knows a really big short seller, he saw that chart. I put that chart up maybe a month ago on NASDAQ, and the person was like, this can't be right. It's just like, it's interesting. Like, people don't necessarily pay attention to a lot of the macro stuff as it relates to the short side. And to me, I was like, yeah, Tom, it's correct. And the deal is that it's increasing the odds of a pretty potential big short squeeze at some point. In our work right now, it's interesting. We look at the range short intensity level. And typically for a stock, the highest it's going to be is 100. The lowest it could be is like 10 or maybe even a 0. But when you come to looking at the sectors, the high end of the range is typically like a 65 and the low is like a 25. And now we have 10 sectors that have short intensity above 50%. So I was talking to someone out on the West Coast who I'm doing a call with next week. And I said, well, here's just a couple quick points for you. On the short side of your book right now, just make sure you're not at risk of having those stocks. If we have a 4% day, your worst names on the short side could be up 8%. Just make sure you're not in that
easily, right?
Yeah, potential situation. And, he's like, well, how do I do that? And like, A, you don't have stocks that are sitting at 52-week lows right now. B, that have a positive PE on them. And C, that, that have a positive, that don't have a positive. So if you're going to be short it, have something that's just total crap, that's not making any money. But the stocks that recover, which is really an interesting idea, as we come out of a bear market or a protracted correction, and it flies against our work, but it is true. The type 4s, the stocks that are weak technically that no one's short, there's a reason they're not short, because a lot of them are value stocks, and they tend to rise the most in an up market, which is really interesting about what happened Tuesday. We didn't really get that. So the S&P was up 2.45%, right? Our short squeezes were up 2.3%. So that's good. But typically when you rebound and you have a stock that's already doing well technically, the shorts don't kind of go and panic and cover that. Instead, they're covering what we call shorts are correct, where a stock is weak technically and the shorts have been making money. And so on Tuesday, that universe was only up 1.65%. So whereas some of the days of that, the 27th of May, those things were up like 6% during that day. So yeah, so it's interesting to see that. So I think we're actually, to your point, it's interesting. You look at, I think strategists are a lot different than technicians, and because they're more opinionated than they are driven by a chart. I mean, then again, you can have confirmation bias with technicians, and you see it all the time. Here's where we are right now. Tom Lee, smart guy, has called a lot of strength in the market over the years. He's at 5,000 right now, and then the bear, Mike Wilson's down at 3,400. That's a pretty wide spread for where we are right now. And I just saw this today. This is interesting. Guy who used to be the head trader at More Capital put out this piece. And everyone knows the first half of this year is one of the worst starts to any year. It's in the top 5. But he listed the top 5 years. The top one was, I think, 1935. We were down 45% for the first half of the year. You know what the return was for the second half of the year? 56%. 56%.
Mean reversion is a funny thing.
It is.
It really is.
And actually, I would argue that mean reversion and standard deviation, which are the most used tools by hedge fund managers on the short side, it's carried out more shorts than any other approach.
Yes. Okay. So all right. So now that's an interesting point. Let me reset the room real quick for everybody that's here. Make sure you follow Geoff and check out his research. You can tell very spoken and really knows this stuff when it comes to some of these dynamics. How much does this need commodities to keep breaking down? Because this is sort of a proxy for me, but I'm looking at EWZ, the Brazil ETF. It's gone round trip. As much as I was talking about Brazil at the start of the year and saying it looks interesting, it had a huge divergence because of that commodity exposure of Brazil. It's pretty much given everything back. I understand there's political elections coming up and other sort of country-specific dynamics, but do you need to see commodities keep coming in for any kind of a melt-up bias scenario? Because if so, just like everything went down, and by everything in stocks and bonds, maybe then everything goes up because that means inflation expectations are going to start dropping.
Yeah, I just think, what's interesting is, so if we look at the DMA channel on a monthly basis, now this is the first month it's gone back below its DMA channel in a couple months. We had a nice run from the end of the year where it ran from, let me just take a look here. Let's see. Okay, so we finished December at 2807 on EWZ, and then we hit a high in March of 3781. So that's pretty nice, 10 into 27, right? And then we went a little higher in April. We hit a high of almost 40, 39.59, and that's where it started giving it up, and now it's lower. And what's interesting, as you say, as you relate to commodities, I think you would probably agree with this, with both the materials and the energy sector, it's pretty impossible for those sectors to be doing well if the underlying commodities that are tied to each of those sectors are struggling. And what's so interesting about energy, this is the 10th down day for energy, like 10 days, but it's already given back the entire quarter. And now we're in the middle of March in terms of performance for the year. That's really a telling phenomenon. So I'm like,
and by the way, doesn't that emphasize the point that nobody knows what tomorrow brings? Because I'm bullish on the commodity case longer term. But I go back to the sequence, it's like when everybody is so one-sided, and you saw that with commodities, right? It's like I joked before that when you have these hashtags and these sort of group identities when it comes to investing, that's probably a sign of you're near some kind of a correction coming, right? And you saw that with Canadian Oil Gang and all this stuff. And again, I'm down with the oil argument longer term, but when you see it popularized with hashtags that are trending, that becomes another red flag to me.
Yeah, so what's so interesting about energy, this move down. Energy had been shorted a couple different times. They really got into it at the beginning of the year. They got caught on it. But we were left with very few stocks being really heavy short interest. And as a matter of fact, if you look at our type 4s right now, 2, 4, 6, 8, 10, let's call it 30 stocks have a type 4 category to them. And only 11 stocks are short squeezes now within the work. So so think about like this. The long squeeze is actually probably a more important idea than the short squeeze, especially for long-only portfolio managers. Because the deal is, if you're in a name, let's just look at something that's a type 4 right now in energy. I'm just looking down the list. Okay, Marathon Oil. That's been a good one. There's just no one short it. The short ratio is 1.09, which again, for people that don't know, short ratio equals days to cover. That's how many days it would take all the shorts to cover their position in Marathon a day. So as the stock starts dropping, like there's no one really covering, and then longs are just selling, and so it's an elevator ride to the downside. And so I just think we're like in this environment where the moves are so brutal. And there's a really great term, Michael, that Phil has. The idea is, what's the definition of long term? And most people, when you ask them that question, they say, oh, it's 12 months or, oh, it's 24 months. And Phil's answer is wrong. The definition of a long-term move is the length of time it takes a move of magnitude to occur. So let me say that again. It's the length of time it takes a move of magnitude to occur. So guess what? Energy just had a big move to the downside because we're down like 20, 30% on a lot of energy names. Like when I looked at Conoco, which we've been short, I was like, unbelievable. I'm like, oh my God, I've made 19% in a month. Like, I'm out of that for now. That's good. I can go to the sidelines again. But I think that's a really interesting idea. And it's come true this year in a really big way. Does that make sense?
Yeah, and I'm reminded of, I think it was on Bloomberg. I remember, I have weird episodic memory, but I remember Lloyd was on Bloomberg in like either very late 2008 or very early 2009. And the negative narrative was so pervasive at the time, post Lehman and financial crisis. And he simply brought up this question. It was kind of a rhetorical question. Is like, what if things go right? What if things go right? And that was towards the low. And I don't see anybody framing things in that construct. And again, if you go back to nobody can predict the future, you have to think of there's a scenario that things go right. What if commodities do keep breaking down? What if inflation has peaked? Now, again, longer term, my entire thesis about to come back up is a rip belly and everything. Commodities probably keep breaking down, but then you still have, I think, and we can talk about this in a bit, longer term headwinds really from housing, which it still have lower lows, which is more of a secular thing. But again, I go back to the sequence here. I think just favors a surprise move. Let me bring in who I spoke with about some of these dynamics. Go ahead and unmute yourself.
I would answer that question for you. I think this is a great thing if you can train yourself to do it. Is okay. So I got the CMDY one up, right? So how does the bias look on a daily basis? It's broken down. It broke through the lower end of the channel back on the 13th June. And then how's the weekly look? And like, okay, it's breaking this week after having been positive since, I'll tell you when it's been positive since the 4th of February. Hell of a move that it nailed. So it just turned right here. And then on the monthly, it hasn't even gotten into the upper band of the DMA channel. So my viewpoint is if you have stuff that are trading ideas, you probably want to be gone from those. The stuff that are more like swing trades, yeah, you can look at them and figure out what you want. But the longer term stuff, what I call the Warren Buffett stuff, stick with it because you're in good shape from a monthly perspective. That's how I'm taught how to think as it relates to those situations. And then, on top of it, just seeing where there's setups, like, i.e., is there a short squeeze going on, or is there a put squeeze? Or the other thing we do, which is really cool work, is seasonality. Like, what's the seasonal trend? Like, I live in Wisconsin. Guess what happens in December? It snows, right? It's amazing how certain stocks have certain seasonality. So when you combine all those things together, it can get really useful. Does that make sense?
But hold on, let's talk about seasonality for a bit, because I think that's an interesting thing, because seasonality is not foolproof, right? I mean,
no,
plenty of times where selling may go away ends up being the best time to buy. And because we live in the small sample, it's hard for people to follow, I think, seasonality, because you'd be wrong in any year or maybe a successive number of years and then say, well, what did I do following seasonality? It's all nonsense. And then suddenly it starts working again. So if we agree that things are in the way that the economy has behaved and the way different intermarket relationships have behaved, does the seasonality of June typically being, a poor. What I'm saying is just talk about seasonality when you're in anomalous periods, because it could very well be that seasonality doesn't matter in a year like this year because everything seemingly is so distinct.
Yeah. So here's what's interesting. The way that Phil created seasonality is we look over the last 15 years. So the oldest year that we're tracking right now is 2007. What'll happen when this year ends, 2007 falls out. And then 2022 becomes a full year. And what we do is December 31st through January 2nd or something, we run all the data again and we get this line and it says, hey, here's what the trend is for the whole year. And then what we do is if we've got 15 years of data, we look at the oldest 7 years and the most recent 7 years, and we compare the two of them and say, hey, how much of a correlation is there, right now to that? And that's how we decide whether we want to have the confidence in it right now. What's so interesting about S&P right now is, hang on, I want to look at SPY for a second just to compare. Yep, same thing. So the correlation is crap right now. It's minus 0.79. So in our work, a perfect correlation is 1, no correlation is 0, and an inverse correlation would be -1. So seasonality, you can throw it out the door. Now, how do we fix that though if we really do want to look at it? What we do is we go into our work and we optimize it and say, aha, is there any other period? And actually what's so interesting, in this case, there isn't. A lot of times you might eliminate '07 to '10, and then there's a good correlation from '11 to 2021. But so yeah, the seasonal correlation isn't great right now on it. Now, so to complete your thought, Michael, on this, if I like to look at the Qs, the 15-year correlation is 0.92. But if I looked at then what we do is we look at the correlation for this year. We call that the 2022 R, and that correlation is minus 0.86. So what I would have to say right now is, I'm not really relying on seasonality to be like my setup indicator on how I'm going to trade. Does that make sense on how we use seasonality?
Yeah, no, I think that point is spot on, right? If the path is behaving differently than prior seasonal periods, then something's different this time around. It doesn't mean it's going to be better or worse, but it's just something to keep in mind. Now, there's something else I want to pick your brain on here, Geoff, which is, to me, intriguing because
Absolutely.
Which means you have to take a little bit of a leap of faith. You have to attempt to catch the falling knife if you want to have. You always hear that line, you never want to catch a falling knife. You always hear that line. Everybody wants to get the juicy middle of the trend. But the reality is, and this is just math, this is compounding, the biggest returns come at the turn of,
absolutely.
Of a trend, right?
Absolutely.
It's the really big returns from a compounding perspective. So let's talk about that in this environment, because I think there are a lot of people that want to see quote unquote confirmation that this is over.
Oh, this is so great, because let's just go back to the DMA channel, the idea of the DMA on a monthly basis. So let's say we're back in 2009, right? And everyone knows we bottomed to 666 on the S&P in March, right? Well, the monthly DMA channel didn't turn positive until July. So by then we were at like 1,200 and we had a huge move in a lot of stocks. So what I kind of went back and did is I said, hey, is there any way that I can get in earlier? And the answer was yes, you can use the weekly DMA channel with the monthly to figure out where I want to have an entry point. And then on top of it, and I'm going to give a couple good examples right now of stocks that I really like in this scenario. I want to look at the relative strength. So I'm looking on a daily chart, but I've got imposed. The cool thing about our charting system is when I'm looking at a daily chart, I can impose like a weekly indicator or a monthly indicator on top of it, which is a really tough thing. Not a lot of people charting wise can do that type of stuff. So I want to know what the weekly is. I want to know what the monthly DMA is. And then, as Phil says, if he was on an island and he could only use, besides the DMA, he could use something else. He'd use relative strength. So how's the relative strength look against the S&P? Are we beating the S&P, number one? And number two, how are we doing against the sector? Are we beating the sector? And then the third thing that I look at is volume. Hey, do we have true buyers here or do we not have true buyers? So an interesting stock that kind of showed up recently on this approach is Zoom, right? We know they're making money. The stock's down from it's like 500, I think. Let's see like a little over 550. And then a couple weeks ago, it finally got into its channel the end of May, and then by kind of like the 17th of June, we were above it. Okay, and relative strength wise, it's beating the S&P. It's beating the software sector. They're definitely buyers of the stock because I can look at our Erlanger volume swing, which is our own version of money flow. But on the weekly, it's not there yet. And we're still way below the monthly DMA. The lower band of it is 187.46. Well, I'm kind of looking at it going, God, if you can go from 116.21 where it is now up to 150, that's almost a 34-point move into 116. We're talking low 30s return. That's a pretty good trade. And so that screen that I've got, I call it the bottom fisher. And there are a lot of pretty interesting companies that are now starting to appear on it, and a great conversation.
And are there any real quick? Are there any sectors or industries that you're seeing more companies pop up from in the list?
Oh, that's a great question. Let me look and see.
Because I would go back to it's a school of fish argument. So rather than trying to choose individual stocks, it's a lot easier to have the tailwind of the group moving in unison.
Yeah, so as I go down, and I'll just tell you it's alphabetical. So there's a decent amount of auto names, a lot of banks, a good amount of capital goods, diversified financials, a good number.
I don't hear much tech in that. That's interesting.
Yeah, I'm going alphabetically, but you're correct. There isn't much so far. Pharma, a ton, and pharma includes biotech. The number of people I know that are clients and stuff, and people I talk to that are interested in XBI, it's a really big number. Pharma is the biggest right now. Tech is decent. We look at 3 tech sectors. We look at computers, equipment, we look at semis, and we look at software. Software is really big in comparison to the other 2. Software is probably triple, quadruple the number of stocks that exist for computer equipment and semis. And so you definitely have, that's really a good question. That's a great question.
Yeah. And it again, I go back to you can make an argument that the sentiment would be most negative maybe towards financials because of the way the yield curve has behaved and lending when, you have a recession. But again, I go back to if everybody thinks that's going to be the eventual outcome, they could still be right, but not necessarily right tomorrow. Maybe there's room there to make money.
Let me finish up this story. This is interesting. So I had a client, Morgan Stanley, financial advisor. She runs a good amount of money, and we did great last year. Like I helped her with a couple of her different portfolios. She was up like 40. She got defensive this year. She's got about 40% cash right now. And we did a little bit of nibbling in March when we got that one run, and we just have waited. And so my argument to her is, as we've been near these lows, is let's just wait until we know we have a meaningful low. I'm getting a better idea now. It's after this week's action. But last week, that would have been a horrible time to add more to stuff. And so I said, if you got 40% cash and we deploy like 20% of it, and we get, let's say you put 4% into 5 positions, and they move like 30% a piece, you're golden. She's like, yeah, I've made my year. I'm going to be up like 10 or 15 with where I'm at right now. So that's the way to do it. I also love the idea. We work with another guy named Fred Meisner, who used to be the head technician for all the financial advisors at Morgan Stanley. And he's a huge dollar cost averaging guy. And we had written a piece last week, and I just used a simple example of, okay, I bought a stock. I'm going to dollar cost average over the next 4 months in a stock, and I bought it at $100. And then next month I bought it at 95. So now my average cost is 97.50. And the next month I bought it at, I think 90 was my number. And then it came down to 95. And then the next month it was like 88. So my net cost was like 93.75. Well, let's assume that 2 months later it got back to where when we first looked at it and could have bought it, it was 100. The return would have been flat. In this case, the return was like 6.75%. So to me, like that's another way to skin the cat with where we are right now too, is dollar cost averaging,
Now, of course, to do that, you've got to have cash.
Oh yeah, absolutely. Right. Yeah, you do. You do have cash.
So let's talk about that because anecdotally, I get the sense that a lot of people are in cash. And I always make it a point that personally, I don't view cash as an asset class. And I think it's more of a residual of the investment process. And I say that only because there's no compounding with cash. There's no chance there. So how could you think of it as an asset class if it doesn't really compound? But from that perspective, do you factor sort of cash levels in your work? Like I've seen studies in the past, for example, that from a contrarian perspective, if mutual fund cash levels are at 5%, that tends to be a buy, or if they're way low, that tends to be a sell because they're fully invested. Does that factor into anything that you do in terms of how you look at setups?
We don't really do cash per se, but one indicator that I really like is our volume swing on the market. So the way that Phil does volume, he's looking at like day over day change. And so if volume, let's say yesterday volume was like 1 million shares and the stock was flat. And then today the stock was up $1, but the volume was 2 million. Then we're going to give more to that next day and consider that a positive. And it's a rolling 20 days. So effectively it's like a rolling 1 month moving average historically through time. And the one thing I will tell you is that as it goes negative, it's been negative almost most of this year, then that tells you that there's a lack of liquidity that exists. And I think that right now we're in a buy. There's no bid. I think that's like the little dirty secret of the market that the average retail guy is never going to understand. There's just no bid to the market. And our score was a -7 2 weeks ago, went to -15 last week, and now we're at -9. So it definitely shows me there's a little bit of buying going on. And this will be another discussion, but intraday we do a lot of stuff. One thing I do is I kind of look at certain moving averages to determine whether liquidity is good or liquidity is bad. And I can tell you that, like, my intraday definition of liquidity, it's crap. I mean, today, as an example, we had the down open. So we had negative liquidity. We got positive liquidity from 10:30 until about noon. Liquidity went negative until about 2. And now we're getting a little bit of it. But the magnitude of that liquidity, so like the liquidity score would be like a 40% for today with an hour left in the market. Because number one, I know this for a fact from talking to people, everyone's taking their book down, their leverage, and they're willing to.
Well, they're degrossing, right? Talking about like the hedge funds.
Yeah. They're degrossing. And who provides most of the liquidity to the market? It's the hedge funds, because they're more active and they trade more than anyone else. I don't think there's any doubt about it that, like, the PT, the plunge protection team, is active at certain times. You can see it pretty clearly when they are. Like, I would argue that yesterday and today they did it during the time that the Powell was speaking. So I definitely think there's a certain degree of that. And now that we're going the other way, now that they're taking money away from giving it back, that may be a tougher thing to have. And I also think this is a whole nother topic, but this whole idea of the gamma trade, its impact on the market is much bigger than what portfolio insurance did.
Can you define that, Joe? Because a lot of people have heard that term gamma trade, but I don't know how many people really understand what that is. Just define what that is for the audience.
So the whole idea is, here's a good example. Right now, the market's been going down. So people have been buying puts and holding on to their puts. So let's say everyone starts to get an inkling that the market's going to go higher, and those people sell their puts, and then the dealer community who provides the liquidity has to go the opposite side, and effectively they take the market up. And so this happens. It used to happen. So here's what's really bad. If you want to provide capital markets for what their true purpose is, you would get rid of this in an instant. The ability to have expiration Monday, Wednesday, Friday on SPY queues, et cetera, does not make a lot of sense. It exacerbates these moves 3 times a week, as opposed to stuff expiring every single week, or even before that when we expired on a monthly basis. So the bottom line is, if you have a dog, think about it like the dog can move on its own, or the tail can move the dog. The tail is moving the market right now, not the dog itself. That's where we are. And it's not understood by a lot of people. And it's a really hard thing to understand, because think about the surface of this whole area, right? Being able to understand what, like, you got to look at stuff's always expiring. And then, so like last week, we just had an expiration. Huge amounts of puts were taken off, or they were rolled to another period. And then you got to analyze that whole surface to figure out, okay, how much of that is going to impact the market here. So I really feel like in a certain way, the options market is really driving the stock market, specifically as it relates to SPY, and then futures on the S&P 500, and then even all the E-minis. One thing I think to get us out of this period is, intraday we use a thing called the value lines: resistance, pivot, support. It's what all the HFT guys use. You can see stuff like right now. I was using an example. If we looked at SPY right this second, oh, here we are. We're sitting on the 5-minute low. We've been sitting there for 20 minutes. Is that a coincidence? Absolutely not. I can see this stuff happening all the time. And when we broke down earlier today, we traded below pivot. We went right to 373, and we stopped on a dime, and then we moved back. So that is a glimpse into the option stuff. Michael, that's a whole nother discussion. But I really do think that's having an influence. And we just don't have liquidity of people being natural buyers of stocks.
By the way, I will say real quick, it makes sense. In high-frequency traders tend to be the marginal source of liquidity. So to the extent that correlations broke down, as we've seen this year, it makes sense that with the combination of degrossing plus correlations being off, that the marginal liquidity provider just isn't playing as much.
Correct. Absolutely. No, I think that's, I mean, look, we didn't get into the technical temperature of the market here, but the technical measure of the market right now is still pretty bad. That's why I'm kind of like, hey, it's like the Missouri market, the show me market. I want you to show me some upside before I'm going to get back in. I don't care about being a buyer at 365 on SPY. I'd rather, quite honestly, see the market get, at a minimum, get above 380, and even better, get above 400. And then I feel more comfortable being a buyer. Like, okay, a low's kind of in. And if that breaks, then so be it. I got to come out of stuff and I'll have some higher turnover. But if it works, and I think that right now, here, I'm just going to go back to this. This is kind of a cool thing to look at.
And we'll say to end that point, Geoff, real quick, that goes back to the catching the falling knife point. And people countered me on this melt-up argument with something I myself have said, which is that it's true. Markets crash from oversold levels. There's no debating that historically. But
Yep.
again, it's at the deep oversold levels, the mean reversion happens. So that's the challenge, right? If they're going to be an extreme, you don't know which direction the extreme is.
Yeah. So here's the technical side of what Brian's asking about. So our technical rank is kind of a cool rank. We use a technique called component layer mapping, which is like barcoding. And Phil started using it back in 1992. So we've been using it for a really long time. And what he did was he threw thousands of chart patterns into the computer, and he let the computer figure out the 10 most prevalent ones. And what's interesting is, so we rank stuff 10% to 100% in 10% increments, but they're not equal weighted. So let's say we've got 5,400 stocks right now. We don't throw 540 stocks in each of the 10 categories. Right now, the majority of stocks are on the 10% through 50% side of the equation as opposed to the 60 and up. But what's interesting is we're getting more sectors now that are beating the S&P. So we now have 11 sectors out of the 24 that have an average tech rank above 50%. So number one is diversified financials. They're at 74%. So they're kicking the butt out of the S&P over the last 100 trading days. Now, then let's say I take that piece of knowledge that I have and I go look at the number of issues that are above their 50-day moving average. The highest sector, this is funny, through last Friday, the highest sector was commercial services at 16%. The lowest was food and staples retailing. Only 2% of food and staples retailing names were above their 50-day moving average. Those two data points together, it's a real head scratcher, unless you really understand the intricacies of what's going on with our technical rank. It's like, how could that be possible?
Yeah, there's a lot of strange dynamics with this. We're running a little bit over, so I think this would be good to maybe do as a follow-up conversation in a few months. Everybody here, please make sure you follow. Yeah, no, please make sure you follow Geoff Garbacz here. As you can tell, a very knowledgeable and different way of looking at market dynamics. Again, the caveat with all this stuff is nobody knows what tomorrow brings, but you have to at least entertain different scenarios, right? And I think that's what we, in general, need to do as an investment community. Is you have to not be so one-sided. You have to question and just entertain different scenarios, recognizing that it may not play out that way, but at least you can maybe on the fringe do something to play that possible future. Geoff, this was a real pleasure. Thank everybody for joining.